There is a question that comes up in almost every serious conversation about money in America, and it doesn't matter whether you're 25 years old just starting to think about your future, or 50 years old trying to make sure the next chapter of your life is financially secure, the question is always the same. Should I put my money into the stock market, or should I put it into real estate? And the reason this question never goes away is because both sides have incredibly compelling arguments, both sides have made people extraordinarily wealthy, and both sides have also left people in serious financial pain. So today we are going to go deep into this comparison, look at the real numbers, examine the real risks, and by the end of this you will have a much clearer picture of which path makes more sense for you personally. Let's start with something that surprises a lot of people when they first hear it. Over the last century in the United States, the stock market, specifically the S&P 500, has delivered an average annual return of somewhere between 9 and 10%. That number includes the Great Depression, World War II, the oil crisis of the 1970s, the dot-com crash, the 2008 financial collapse, and the pandemic shock of 2020. Through all of that devastation, through all of those moments when people were absolutely convinced the system was finished, the market recovered and kept climbing. 9 to 10% per year, on average, over 100 years. That is an extraordinary track record. Now real estate, on the other hand, has historically appreciated at somewhere around 3 to 4% per year on average across the United States. When you see that comparison, 10% versus 3%, it looks like the stock market wins easily. But that framing is actually incomplete, and understanding why it's incomplete is one of the most important things you can do for your financial education. The reason that comparison is misleading is a concept called leverage. When you buy a stock, unless you are trading on margin, you are paying for 100% of what you own. You put in $10,000, you own $10,000 worth of stock, and if it goes up 10%, you made $1,000. That's your return. But when you buy real estate in America, almost nobody pays cash for the entire property. Most people make a down payment. Let's say you want to buy a $300,000 home or investment property, and you put down $60,000, that's 20% down, which is very standard. Now here's where the math becomes fascinating. If that property goes up in value by just 4% in a year, it went up $12,000 in value. But your initial investment was only $60,000. 12,000 divided by 60,000 is a 20% return on your actual cash invested. That is the power of leverage, and it is the single biggest reason why real estate has made so many people in this country genuinely wealthy, even though the raw appreciation rate looks lower than stocks on paper. But leverage is a double-edged sword, and anyone who lived through 2008 and 2009 in this country knows exactly what that means. When real estate prices fell during the housing crisis, and in some markets they fell by 30, 40, even 50%. The people who had used leverage to buy properties didn't just lose 30 to 50% of their investment. Many of them lost everything they had put in, and then they still owed money to the bank. That is the dark side of leverage. The same mathematical force that can turn a 4% appreciation into a 20% cash-on-cash return can also turn a 20% price decline into a complete wipeout of your equity. The stock market has never done that to someone who simply owned a diversified index fund with no margin. You could have bought into the S&P 500 at the absolute worst possible moment before the 2008 crash, held on, and within about 4 to 5 years you were back to even. Real estate investors in the hardest hit markets waited much longer than that, and many of them never fully recovered because they couldn't hold on long enough. Now let's talk about something that doesn't get enough attention in these comparisons, which is the income dimension. Stocks pay dividends. If you own a diversified portfolio of American stocks, you're currently looking at a dividend yield somewhere around 1.5 to 2% per year. That's real cash coming to you. But real estate that you rent out is an income machine in a way that stocks simply cannot match for most individual investors. A well-purchased rental property in a solid American market can generate a cap rate, that's your net income divided by the property's value, of anywhere from 4 to 8% per year, depending on the city, the property type, and how well you manage it. When you combine that rental income with appreciation and leverage, you start to understand why so many people who built real wealth in this country did it through real estate. It's not just about the price going up. It's the fact that someone else is paying your mortgage while the asset appreciates. This brings us to one of the most powerful and underappreciated benefits of real estate investment in America, which is the tax treatment. The United States tax code is genuinely favorable to real estate investors in ways that make a significant difference to long-term wealth building. First, you have depreciation. The IRS allows you to deduct the value of your residential rental property over 27.5 years, even if the property is actually going up in value. This creates what's called a paper loss, which can offset your rental income and reduce your tax bill substantially. Second, there is the 1031 exchange, which allows you to sell an investment property and roll all of the proceeds into a new, larger property without paying capital gains tax at the time of the sale. You can do this multiple times throughout your life, continuously growing your real estate portfolio and deferring the tax bill indefinitely. Third, if you live in a property as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 in capital gains from taxation if you're single, or up to $500,000 if you're married. These tax advantages are real, they are substantial, and they are one of the reasons that real estate has been a primary wealth-building tool for American families for generations. Stocks are not without their tax advantages either, of course. If you invest through a 401k or an IRA, your money grows tax-deferred or even tax-free, which is enormously powerful over decades. The Roth IRA in particular is one of the most valuable financial tools available to American workers, because you pay taxes on the money going in, and then every single dollar of growth, every dividend, every capital gain, all of it comes out in retirement completely tax-free. The mathematical impact of decades of tax-free compound growth is staggering, and it's one of the strongest arguments for prioritizing stock market investing through tax-advantaged accounts before moving into other investment vehicles. Let's be honest about something that real estate advocates don't always emphasize, which is the reality of being a landlord. Real estate is not a passive investment for most people. When you own rental property, you are running a small business whether you want to be or not. Tenants call at midnight because the heat stopped working. Pipes burst. Roofs leak. Appliances fail. People stop paying rent and have to be evicted, and evictions in many American states can take months and cost thousands of dollars in legal fees. Property taxes increase. Insurance premiums rise. You have to make decisions constantly. Should I replace the carpet now or wait? Should I raise the rent or risk losing a good tenant? Should I hire a property manager and give up 8 to 12% of my rent roll? These are real demands on your time and attention and emotional energy, and they are categorically different from the demands of owning a stock portfolio, which are essentially zero once you've set up your automatic investments. This is where stocks have a decisive advantage for a very large number of people: simplicity and accessibility. You do not need to qualify for a mortgage. You do not need a down payment of tens of thousands of dollars. You do not need to find a property, inspect it, negotiate the purchase, deal with title insurance and escrow and home warranties. You can open a brokerage account today, put in $25, buy a fraction of a share of a low-cost index fund, and begin building wealth immediately. The barrier to entry is essentially zero, and the ongoing management burden is essentially zero. For working people who are time-constrained, who don't have significant capital saved up, or who simply don't want to deal with the complexity of being a property owner, the stock market offers a path to long-term wealth that real estate cannot match for sheer ease and accessibility. Liquidity is another critical difference that often gets overlooked until it matters desperately. If you need money and you own stocks, you can sell them in seconds and have cash in your account within 2 to 3 business days. If you need money and your wealth is tied up in real estate, you are looking at a process that typically takes 30 to 60 days at minimum, involves real estate agents and their commissions, closing costs, inspections, and negotiations, and that's assuming the market is cooperative when you need to sell. In a down market, or if the property has issues, you might be looking at months. This illiquidity is one of the most underappreciated risks of heavy real estate concentration. Life has a way of presenting financial emergencies at the worst possible moments, and being asset-rich but cash-poor is a genuinely difficult position to be in. What does the data actually say when researchers try to do a head-to-head comparison with all factors considered? Studies like the one published by economists Oscar Jorda, Katerina Knoll, Dmitry Kuvshinov, Moritz Schulerich, and Alan Taylor, a landmark study covering 16 countries over more than a century, found that residential real estate and equities have actually delivered surprisingly similar total returns over the very long run, but with an important difference: real estate had lower volatility. That's a significant finding. It means that on a risk-adjusted basis, real estate has historically been a very competitive asset class, and the emotional and psychological experience of owning real estate through a downturn is generally easier than watching your stock portfolio fall 30% on a screen. There is a geographic dimension to this conversation that is impossible to ignore. The United States is not one real estate market. It is thousands of local markets, and the outcomes for real estate investors vary enormously based on where they bought. Someone who purchased a home in San Francisco in 1990 has experienced appreciation that makes any stock market return look modest. Someone who bought in Detroit at the wrong time experienced decades of declining values. Someone who bought in Austin, Texas in 2015 saw their property double in value in less than a decade. The stock market, by contrast, is far more uniform in its returns across investors, because everyone who owns the same index fund gets exactly the same return. Real estate's geographic variance is a feature for people who can identify undervalued or high-growth markets, and a serious risk for people who simply buy whatever is nearby without doing deeper analysis. The psychological dimension matters more than most financial discussions acknowledge. Research consistently shows that one of the biggest destroyers of investor returns is emotional selling, buying when the market feels exciting and selling when it feels terrifying. Real estate has a structural advantage here for many people: it is illiquid, which means you cannot panic sell at 3 in the morning when you see bad news on your phone. The friction of selling real estate forces a kind of involuntary discipline that many investors benefit from enormously. The stock market, with its second-by-second price updates and the ability to sell everything with 2 taps on a smartphone, can turn a smart long-term investor into an emotional short-term speculator faster than almost anything else. Warren Buffett has said repeatedly that the stock market is designed to transfer money from the impatient to the patient. Real estate's inherent friction helps enforce patience in a way stocks cannot. What is the right answer for you specifically? It depends on several things. It depends on your capital, how much you have and how much you can access. It depends on your time, whether you have the hours and energy to manage property or whether you need your investments to be entirely hands-off. It depends on your risk tolerance, your tax situation, your local real estate market, and perhaps most importantly, your temperament. Some people are genuinely well suited to being landlords. They're practical, they're organized, they don't mind dealing with contractors and tenants, and they find the tangibility of owning physical property psychologically reassuring in a way that a brokerage account statement never will be. Other people would find all of that an absolute nightmare, and for them, the simple elegance of a low-cost index fund held inside a tax-advantaged retirement account is not just easier. It will actually produce better results because they'll stick with it through downturns. The most honest answer, and the one supported by the financial data, is that both asset classes have legitimate and powerful roles in a well-constructed wealth-building strategy. Many of the wealthiest Americans didn't choose one over the other, they built foundations in both. They maxed out their retirement accounts, built stock portfolios for liquidity and diversification, and used real estate for leverage, income, and tax efficiency. The question is not really which one is better in the abstract. The question is which one is better for you right now, given your actual situation, your actual goals, and your actual capacity to manage the complexity that comes with each path. If you understand the mechanics of leverage, have the capital for a down payment, can handle the operational demands of being a property owner, and are investing in a market with real supply constraints and demand drivers, real estate can be an extraordinary wealth-building vehicle. If you are earlier in your financial journey, working with limited capital, value simplicity and liquidity, and want to invest in a way that requires almost no ongoing attention. A diversified stock portfolio is one of the most reliable paths to long-term wealth that has ever existed. The right move is to understand both deeply, be honest with yourself about your situation, and then act decisively rather than spending years debating while doing neither.